What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be taking a look at a stock that a lot of people recommended me do an analysis on, and that is Uipath. So this is a software artificial intelligence company that helps businesses run more efficiently. So today, we're going to take a look at it, do some in-depth stock analysis, and find out if this is a good time to invest in the stock. So how I just said, they deal with artificial intelligence, and the way they make money is they sell their AI software to businesses so that they can run more efficiently. Now, there's lots of companies out there similar to this one, and one that came to mind was Palantir, because Palantir is another popular company that has AI software, and they also have a money-losing business, unprofitable, but they are growing revenue fairly quick. So they have a couple things in common. So that's a good stock that I think is a good comparison for Uipath. If we take a look at the stock chart, the company went public in April of 2021. So we're approaching 2 years now of when it went public. And as you can see, I'm sure shareholders are not happy because they're down 75% in the last 2 years. So not a very good stock chart there. And if we take a look at their revenue and net income, we can see that revenue has grown, right? From 2020, they were doing 113 million a quarter. In the most recent quarter, they did 262 million. So more than a double up there in less than 2 years. So that is a good sign. However, when we look at net income, they're still losing money. So that's not a good sign. So number one on our checklist is going to get a yes, and number two is going to get a no. Number three is looking at the PE ratio, or if they're not profitable like this stock, then we're going to look at the price to sales. And in this case, the price to sales for this stock, well, first let's look at how much is this company growing for the next year or two. Well, we have 15% growth expected this year and a little bit over 17% growth expected for next year. So let's keep those numbers in mind. Their price to sales is a 9.2. So I would say that's a fairly rich valuation so far. We're going to do some comparisons too. So right off the bat, I know one company that trades around that price to sales is Microsoft, and they're growing at about 10% a year. So that's something to compare them to. Now, if we look at Palantir, what we can see here is Palantir trades at a similar price to sales of a 10. However, so remember, similar business models, similar financial conditions, same exact price to sales, but Palantir is growing 23% this year and expected to do 20% next year. So a little bit more growth expected with Palantir, even though you're paying pretty much the same price. So that's interesting. So that's why for number three, I'm going to give that a no. Number four is, are they innovative? Do they have a moat? I said yes. This is an AI software company, which is pretty much at the forefront of innovation right now. And as far as where we're at, AI is one of the hot topics out there. So I would count artificial intelligence software as something innovative. Number five, is the industry growing? Yes. We can even look up like AI software growth rate, and it's expected to grow 37% for the global artificial intelligence market size from this year until 2030. So that is definitely one of the highest growing or fastest growing industries out there. Usually that number, when I looked that up, it's 5 to 10%. So that's a pretty strong number. Number five is going to get a check. Number six, return on invested capital is negative, so I could say no. Number seven, their cash flow is not good. Once again, this is a money-losing company. I understand that they're still a young, growing company, so that's to be expected a lot of times, but they're investing so much money. There's so much money flowing out and not that much money flowing in. So not really, there's a lot of hurdles they're going to have to get over to break into that profitability. So operating cash flow has gotten not much better. They were doing negative 300 million a couple years ago. They had 2021 do 29 million, then negative 50 million. Now we're at negative 100 million. And they invested 168 million out of that. So you can see last year, they got they financed $1.4 billion. So there's some money. And then remember, we have high interest rates right now. So that's not working in their favor either. A cash position of 1.4 billion, okay. And free cash flow is negative 135 million. So definitely not what I would consider a healthy cash flow statement. Number 8, diverse revenue streams. No, they just make money through their software. Number 9, growing equity. Equity is looking like, well, they just raised that 1.4 billion. So that's because otherwise before that they had negative $800 million of equity. Now we're sitting at 1.8 billion of equity. So again, they just raised all that money. And so that's going to get a yes. Number 10, is the equity over 15% of the market cap? Yes, by a hair it is, but it still counts. Number 11, share count decrease. No. Now this one was also to be expected. This type of company would normally be issuing more shares, diluting shareholders. So it's to be expected. However, it's not as bad as lots of other companies out there. You can see in 2020, they had 492 million. Now they have 550 million. So definitely an increase, definitely not helping the share price, but not as bad as a lot of other tech companies out there. Then if we look at insiders and big money, yes, ARK Invest is probably one of the biggest reasons this stock got some popularity. They're one of the biggest holders of this stock, so they do have some big hedge funds. I think they also have 11% of the insiders hold the shares, so that's also a relatively high number. Respectable management, I put no. Now, there's lots of ways to think about this, but the main thing that sticks out to me is they went public in April of 2021 when the stock market was pretty much at its hottest, right? That was like the peak almost. And they went public, $65 a share. And now we're at $16 a share. So is that responsible of management to go public at this time, at this valuation? And now anybody that's put any money into this has lost up to 75% of their money over the last 2 years. That doesn't sound good to me. So that's going to get a no. Number 14, they do have more. They have, how we just said, 1.4 billion in cash. They have zero income, so I could take check. No dividend, and no, the company is not 20 years old. They were founded in 2005, so not 20 years old yet. All in all, it gets a 7 out of 16. Definitely not considered a buy. So unfortunately, I'm not a huge fan of this one. There's lots of companies doing what they're doing in that AI / software business space, and that's great. I think that there's a huge future for that, but it's just too early on. There's too many things these companies are going to cross. It's almost like the early 2000s .com bubble, because lots of money losing companies, high interest rates. Now they have a lot of them have a lot of debt. They're not making money. There's lots of competition. Nothing is proven yet. And it's just, from an investing standpoint, it does not look that attractive. So I would wait until it becomes a little bit more concrete of how they're going to make money, who the major players are, and all of those sorts of things. So that is my opinion on this stock. If you have any more recommendations, comment down below. Thank you for watching. I will see you guys in the next video.